ST Engineering stock is up nearly 80% in the past year, driven by record revenues and robust order bookings. But should you buy the dip now, or is it too late? Let's break it all down. Welcome to Durian Finance, and today we'll analyze ST Engineering's latest quarterly and FY24 performance, dissect its business by segment and geography, compare financials versus peers, and provide a clear investment verdict. Quick disclaimer. This video is for informational and educational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. The creator of this content may hold positions in the companies mentioned. Let's dive into what ST Engineering actually does and how it earns over $11 billion a year. In FY 2024, ST Engineering reported a record revenue of 11.28 billion Singapore dollars, up 12% year-on-year, while net profit surged 20% to around $702 million. These aren't just impressive numbers. They're also backed by solid operating margins and growing global demand. So, where does all this money come from? ST Engineering operates across three major business segments. First up, commercial aerospace. This unit pulled in $4.38 billion, making up about 39% of total revenue. It includes aircraft maintenance, nacelle systems, composite panels, and freighter conversions. Earning before interest and taxes in this segment climbed 19%, driven by post-pandemic recovery and high demand in aviation services. Second, defense and public security, or DPS. This is the largest segment, generating $4.94 billion, or 44% of total revenue. It covers land systems, cyber defense, AI-driven analytics, and digital defense platforms. Earning before interest and taxes here was a solid $636 million, with particularly strong growth in digital systems, up 39% year-on-year. Third, urban solutions and Satcom, contributing $1.96 billion, about 17% of total sales. Though revenue was largely flat, earning before interest and taxes improved significantly, rising from just $10 million to $40 million, thanks to better margins in satellite communications and smart city projects. And what about geographic reach? Asia remains ST Engineering's core base, contributing 51% of revenue. That's around $5.75 billion. North America follows with 23%, Europe at 19%, and the rest of the world at 7%. They build a truly global footprint, operating in over 100 countries, with more than 50 hubs across the United States alone. This scale allows them to absorb regional shocks and tap into growth markets worldwide. In FY 2024 alone, they secured $12.6 billion in new contracts, and they're sitting on a massive order book worth $28.5 billion, with $8.8 billion already scheduled for delivery in 2025. What does this tell us? ST Engineering's diversified business model and international footprint create a strong, defensive base with multiple engines of growth, spanning aviation, defense, and smart infrastructure. And that's why investors are watching this company closely. Now, let's take a closer look at how ST Engineering performed in the first quarter of 2025. Group revenue rose a solid 8% year-over-year, reaching 2.92 billion Singapore dollars, up from 2.7 billion in the same quarter last year. Leading the charge, Defense and Public Security, or DPS, posted a remarkable 18% jump to $1.32 billion. This growth came from multiple fronts, like AI-powered command and control systems, international defense electronics sales, ship maintenance contracts, and cybersecurity solutions. Commercial aerospace came in flat at $1.15 billion. But don't be fooled. This was against a high base in Q1 last year, when aerospace revenue spiked 32% over the previous year. This quarter saw strong growth in engine maintenance, but that was largely offset by weaker demand for freighter conversions. Over in urban solutions and Satcom, revenue rose 4% to $446 million, driven by smart mobility projects in Singapore and the U.S., though Satcom revenue was slightly softer, with expectations for a stronger second half. Now, here's where things get exciting: new contracts. ST Engineering secured a whopping $4.4 billion in fresh contracts just this quarter. That pushed their total order book to nearly $30 billion. Specifically, $29.8 billion as of March 2025. Among these wins were 15-year engine maintenance deals with major airlines in the Middle East and Asia, component service contracts for Boeing's 787 aircraft, smart transport infrastructure projects for Singapore's downtown and cross-island MRT lines, and satellite ground systems for aviation, defense, and maritime clients globally. This robust pipeline, combined with reliable execution, is exactly what underpins ST Engineering's sustained growth, and it's what keeps investors paying attention. In FY 2024, ST Engineering delivered record revenue of 11.28 billion Singapore dollars, up 12% from the previous year. Net profit surged 20% to 702 million, thanks to strong contributions across all business segments. EBITDA and gross margins remained stable at around 14% and 19%, respectively, reflecting good cost control despite inflationary pressures. Profit margins improved to 6.2%, indicating more efficient operations. Studio microphone valuation-wise, the company trades at a PE of about 35 times, with an EV to EBITDA ratio of 13.5 times. Its price-to-book ratio rose to 5.4 times, suggesting investors are paying a premium for strong fundamentals. Dividend yields slightly compressed to around 4% as the stock price rallied. At the end of 2024, shares traded at 4 Singapore dollars and 66 cents, up from 3 Singapore dollars and 89 cents a year earlier. And as of July 7, 2025, the stock reached 7 Singapore dollars and 81 cents, a clear vote of confidence from the market. Total assets climbed to 16.2 billion Singapore dollars, while liabilities rose to 13.3 billion Singapore dollars. This left shareholder equity at 2.67 billion Singapore dollars, up from 2.46 billion Singapore dollars in 2023, supported by retained earnings and business growth. Gross borrowings dropped by 5% to 5.82 billion Singapore dollars, and net debt also fell slightly. As a result, their gross debt-to-EBITDA ratio improved from 4.2 times to 3.6 times, showing reduced financial leverage and stronger resilience. On the liquidity front, cash reserves rose to 430 million Singapore dollars, and operating cash flow jumped 46% year over year to 1.72 billion Singapore dollars. Levered free cash flow, cash left after servicing debt, came in at a strong 449 million Singapore dollars. What's most exciting is the forward visibility. ST Engineering ended the year with an order book of 28.5 billion Singapore dollars and 8.8 billion Singapore dollars of that is already locked in for delivery in 2025, giving investors high confidence in future revenue streams. Over the past 5 years, ST Engineering has shown a remarkable turnaround from the COVID era. In FY 2020, revenue fell to 6.16 billion Singapore dollar due to aviation shutdowns, but net profit held steady at 570 million Singapore dollars. By FY 2021 and FY 2022, revenue climbed to 9 billion Singapore dollars, with steady gains in EBIT and EBITDA, though market sentiment stayed cautious. In FY 2023, revenue crossed 10 billion Singapore dollars, and profits rebounded, driving a 17% rise in share price. FY 2024 capped it off with 11.28 billion Singapore dollar revenue and 702 million Singapore dollar net profit, up 20%, while shares gained another 16%. From 2020 to 2024, revenue jumped 83%, profit grew 23%, and ST Engineering clearly emerged stronger, leaner, and more investor confident than ever. Let's see how ST Engineering compares with regional peers like SIA Engineering, Babcock, and Kongsberg. With a market cap of 24 billion Singapore dollars, ST is much larger than these peers and trades at a PE of 35 times, reflecting strong growth and a diverse portfolio. Its EBITDA margin of 8.7% outperforms most competitors, though its debt-to-EBITDA ratio of 3.6 times is slightly higher, but manageable given strong cash flow. In contrast, Peers tend to have lower valuations and margins and less exposure beyond aviation. Bottom line, ST Engineering's premium is backed by size, earnings quality, and a forward order book few can match. Now, let's see what local brokers and banks are saying about ST Engineering. UOB High-End reaffirmed a buy at 5 Singapore dollars and 55 cents, but later shifted a hold, citing rich valuation after Q1's strong performance. Phillips/Poems rates it accumulate with 8 Singapore dollars and 20 cents target, citing growth in defense and aerospace as key drivers. RHB remains bullish, rating it buy and lifting their price target at 8 Singapore dollars and 90 cents on continued momentum. DBS Bank, however, downgraded a hold with a 7 Singapore dollars and 70 cents target, calling valuations elevated after the recent rally. Finally, Nomura maintains an overweight rating, targeting 7 Singapore dollars and 50 cents, up from a prior view. In summary, local analysts are split. Targets range 5 Singapore dollars and 55 cents to 8 Singapore dollars and 90 cents, reflecting differing views on valuation versus growth. Keep an eye on how revenue delivery and contract wins validate the rally. ST Engineering is trading at lofty multiples, a trailing P around 35 times, forward 29 times, and a PEG near 2 times. High expectations embedded in its valuation. But with growth comes risk. Tariff-induced delays in aerospace revenue have been flagged at up to 40 million Singapore dollars per month, with macro factors like interest rates and supply chain issues layering on pressure. Studio Microphone Urban Solutions margin compression, geopolitical uncertainty, and cybersecurity vulnerabilities also pose risks. Credit-wise, ST Engineering rates mid-range among aerospace and defense peers, strong but not risk-free. That 28.5 billion Singapore dollar order book is a major strength, yet with elevated valuation. The potential downside outweighs the upside until we see consistent delivery, margin improvements, and stability in aerospace. In short, the stock looks primed for continued gains, but any hiccups could lead to a sharp re-rating. Given strong fundamentals, global diversification, and solid backlog, ST Engineering remains a buy, particularly if you're a long-term investor comfortable with its valuation. If you're cautious on cyclicality or prefer value plays, it may be worth waiting for a pullback, but absent a sharp market correction, growth appears sustainable. Thanks for watching. Would you buy ST Engineering now? Drop your thoughts below. Don't forget to like, subscribe, and hit the bell for more deep dives.